Hello, everyone. Thank you for joining us. My name is Henry Duong, and I am the Education Manager and Los Angeles Field Representative at CalNonprofits. Welcome to the What Nonprofits Need to Know About CalSavers webinar. We are honored to have CalSavers presenting this webinar with us, and let us get started. So just a word about CalNonprofits and who we are. CalNonprofits is an association of nonprofits. So we are a little bit like the Chamber of Commerce for the nonprofit sector. We work on a variety of programs where we help nonprofits find resources from government agencies or information about government programs like the CalSavers program today. And we make sure that nonprofits have a voice in the decisions that are made about us and about the communities we serve. We work in Sacramento as well as at other levels of government, as well as with our philanthropy partners, coalitions, and the public to advocate for CalNonprofits. We have a quick poll for everyone. Let me launch that. And let me get your guys' input. And here are the poll results. It looks like most of you joining us say that your organizations have between 5 to 10 employees, and then the next top option is 11 to 25. And then I'm glad most of you have heard of CalSavers. About 26% haven't here. So this is something that for our speakers to just know about our audience. Okay, let me turn it over to our moderator for the day, our CEO, Jan Masaoka. Take it away, Jan.
Thanks very much, Henry. Hey, it's great to see so many people from such different parts of the state and such different kinds of organizations. Just really terrific to see all of you. Welcome. And one of the things I want to say why I'm so happy all of you are here today, and we have, I think, well over 200 people we're expecting, is that I think we all know that saving for people in retirement or post-work life era parts of their lives is really a national, international crisis. So this is something that it's important for all of us to be paying attention to, not just those of us who work in the nonprofit community, but especially happy to see so many folks here. As Henry mentioned, our main speaker today is Jonathan Herrera. He's the Director of Outreach and Education at CalSavers and a longtime friend and supporter of CalNonprofits and CalNonprofit organizations. And he used to be at Citibank. And right after this webinar is over, he's going to run out and get himself a carnitas taco or two. So that's one of his favorite lunches. And so you'll know that he's having that on his mind while he talks today. So thank you, Jonathan, for joining us. Before he starts, though, I want to make just a couple of comments. And can I see the next slide? Thanks. So, the fact is that it used to be that nonprofits before 1958 were legally barred from having retirement plans. And that's an indication of how the public thought about nonprofit work, that you shouldn't be able to have enough money doing it to save for anything. That's it. And this shows you the changing public views about nonprofit work. In 1958, nonprofits were finally allowed to have 403B plans, but employers were not allowed to contribute. And these plans were only allowed to invest in annuities from insurance companies. So again, just a very limited, with the idea being that, you shouldn't be doing this work with the expectation that anybody's contributions are going to help you later on in life. 1974, nonprofit plans were first allowed to invest in mutual funds. And then it was not until 1996 that nonprofits were allowed to have 401k plans. So the point here is not for you to memorize this history, but the point is that attitudes about nonprofits and retirement have changed dramatically, but it is still relatively new in history for us to be thinking about retirement the same way other folks have. Next slide, please. So a myth about nonprofits is that compared to for-profit companies, we actually don't do retirement. And in fact, the opposite is true. If we look at the same organizations with the same number of employees, we see that actually nonprofits are 3 times more likely than for-profits to be offering retirement benefits. So we shouldn't have sort of an inferiority feeling. We should have sort of a superiority feeling about this. I think tendency, though, is for us, if we work in a nonprofit like the poll says, that has maybe 10 to 25 employees, and we're comparing our retirement benefits with, a big company like Google or something like that, yes, and they do have better retirement benefits. But if we look at organizations the same size in the for-profit sector, say 10 to 25 employees, we are actually more likely to have retirement plans. So that doesn't mean that we're out of the woods, but I think we shouldn't be embarrassed or believe that we have fewer benefits in this area than for-profit companies. Okay, next slide. So I want to also call your attention. First of all, I should say CalSavers came into being as a result of legislation, and it's legislation that we at CalNonprofits supported and we're very happy to see pass. So it's a nice thing to see something happening now that we were part of supporting and being part of its creation. There is new legislation that is right now that is going to be voted on this year in the legislature. And it goes by the very sexy name of SB 1126. But what it does is it would change the number of well, let me start again. Right now, if you have to have 5 employees or more to be able to participate in CalSavers. To be required by CalSavers. Maybe I haven't had enough coffee today. To be required to have a retirement savings plan for your employees. This bill would make it mandatory starting at 1 employee or more. And we at the California Association of Nonprofits are supporting this bill because it does not mandate employer contributions, but it does mandate that you have a plan available for your employees. They don't have to enroll in it, but we think it should. We think it's a good idea for that to be made available to all members of the nonprofit employee community. So be on the lookout for alerts from us about that. And we want to make sure that all of us who agree with that position are supporting that bill. Okay, so with that, I want to turn this over to Jonathan. He's going to mention some alternatives to CalSavers, and I will as well at the end. But I just wanted to say a word about CalSavers and why, one of the reasons why I personally am so supportive of people learning about it and participating about it. And I'm going to use the analogy of baby carrots. And I think you guys know that, like, if you were to say, for example, at your office lunchroom, to put out some carrots, that are still in a bag and have green stuff coming out of the top, very few people would go into your lunchroom and pick up a carrot, wash it, peel it, cut it, and then eat it. But if you were to put out a bowl of baby carrots into your lunchroom, within a couple of hours, magically, all those baby carrots would have been eaten. And the reason I'm pointing this out is because one of the things that we know is the most important in people participating in retirement plans is easiness. And so I think of CalSavers to some degree as the baby carrots in the snack room of the retirement world. And so one of the reasons why I'm such a big supporter. So Jonathan, go ahead, and we want to hear your presentation. And I want to let everybody know I'm watching. Henry and Vanessa and I are watching the questions, and I might be interrupting you, Jonathan, as we go through this with some of the questions. Okay, so your microphone.
Perfect, Jan. Thank you so much. And I think it'd be great to take questions, throughout the presentation. So feel free to interrupt me. I've got a couple of divider slides where I sort of shift the topic a little bit. So those might be perfect times to do that. But good morning, everybody. Thank you so much for having me today. And, let me start by especially saying a big thank you to CalNonprofits for hosting us today. As Jan mentioned, CalNonprofits has played a huge role in, the development, the advocacy, the design of the CalSavers program. So, we're really excited to continue the partnership and be able to share this program with you, especially after CalNonprofits and nonprofits in particular, or in general, played such a big role. I always like to remind Jan that when we launched our pilot program back in 2018, I think we launched the pilot program. about half, more than half of the early participating pilot employers were actually nonprofit organizations who heard about us through some of the early advocacy and outreach work that CalNonprofits helped us with. So thank you for that. Really excited to be joining you guys today to talk about how California is working to address this retirement savings access gap that exists in the state. And yes, of course, discuss the state's new retirement mandate and why this is an important compliance issue for nonprofit organizations to be aware of. So as I'm sure you gathered from the introduction, CalSavers is the state's new retirement savings program designed for the millions of Californians who don't have a way to save for retirement at their job. It was created by legislation, as Jan mentioned, that passed back in 2016 that actually does require California employers who have 5 or more employees and who aren't sponsoring a retirement plan to basically enroll in CalSavers and facilitate your employees' access to the program. We designed it as an automatic enrollment individual retirement account with no employer fees or fiduciary responsibility. I'll talk about that in a little bit more detail. But I think that it's a really important conversation to be having right now for a couple of reasons. First of all, is the job market. We're hearing from lots of employers all over the state talking about how hard it is to fill open positions, keep your current employees. And employers right now are looking for ways to make their businesses or their organizations look more attractive to prospective employees and retain those existing staff. And I think that especially small organizations have always felt, like Jan said, that they weren't able to compete on retirement benefits, because oftentimes they don't have the resources, whether it's staff or financial, to be sponsoring a plan. And that's, one of the reasons why CalSavers was designed with no employer fees to sort of level that playing field for smaller organizations. And the other thing that we're hearing from employers is that, as a result of the pandemic, with so many people working to overcome the financial setbacks caused by, the situation, more employers are looking at ways to help their employees improve their financial wellness and save for the future. So we're excited to be promoting this program during this period of time because now more than ever, we can see how vital it is for, workers throughout the state of California, regardless of the industry that they're in. Nonprofit employees included, to have financial resiliency in both the short and long term. And that's exactly what CalSavers was designed to do. So my plan today is to talk a little bit about, give you some background on the program, talk about what it's all about. We'll talk about how it affects employers. So if your organization decides to sign up for CalSavers, what does that going to mean? What are your responsibilities going to be? And then, of course, we'll spend some time talking about how this affects your employees and what they'll get access to if they do sign up for the program. So I think, the best place to start is to talk a little bit about the situation that exists in the state that, the legislature is trying to address when they passed the bill. And what it comes down to is we see that nearly half of Californians are projected to retire into economic hardship if they can retire at all, which is a really sobering statistic when you think about it, right? And we think that a key driver of that situation is that there's millions of Californians who are going to work every day, playing by the rules, but lack access to a workplace-based retirement program. And that's really important because the research also shows that workers are 15 times more likely to be saving and be on a path towards retirement security if they have access to a payroll deduction savings program at work. Just a simple way to save small amounts automatically from their paycheck, set it and forget it, but slowly over time making a dent in their financial future and their retirement security. That number actually goes up to 20 times more likely if the program features automatic enrollment, which is something we are proud to say CalSavers does. And we'll talk about that in a little bit more detail in just a minute. But knowing that the best way to get folks saving and on a path towards retirement security is through the workplace, back in 2016, the legislature passed this bill, which really did 2 important things. Number one, and most important, for you all as employers, is that it did create this new mandate on California employers. But the second thing is that it did authorize the creation of this CalSavers program so that we could, at the same time that the state's offering a mandate, we're offering this fee-free, liability-free solution for employers to be able to use and satisfy the conditions of this mandate in an easy way. So let's talk a little bit about that mandate. So what it says is, again, any business in the state of California that's not currently offering a retirement program and who has 5 or more employees is going to be required to register for CalSavers and facilitate their employees' access to the program. Now, I've noticed a lot of questions in the Q&A already about how we measure employees and what counts there. So let's talk about that for a second. So the way we determine an organization's number of employees is by looking at the average number of employees that you're reporting to EDD on for the previous calendar year. So we look at those DE9 filings, the quarterly wage reports that you all are filing with EDD, and we average out all 4 quarters for the previous calendar year. But what's important there is we're not distinguishing full-time or part-time or even seasonal employees. So all employees, regardless of how many hours they worked or how long they were with your organization, if they reported on that DE9, will count towards your average number of employees for the year. And then what we're doing is we're looking at we get fresh data from EDD every April, and we determine employers' eligibility every year. But once we determine that you're eligible, you'll stay eligible at least for that calendar year until we get fresh data from EDD. So in other words, if an employer, go ahead, Jan.
All right, so there are so many questions about this, so I just want to make sure. So when counting number of employees, part-time employees count as well as full-time, right? And temporary,
that's right.
And temporary employees also count.
Yes, yes. Any employee that's reported on that wage report will affect the average number of employees for the year.
Thank you. Okay.
You know, and one of the reasons we did that was because we thought that would provide a little bit more stability for those employers who might be up and down around that number of 5 employees. And we didn't want employers to think, oh, well, I'm out this month or I'm out next month. But what we found out was that there are a lot of employers whose average number might go up and down around that 5. And that's one of the reasons why you know, the legislature is now examining this bill that you mentioned, Jan, SB 1126, to try to lower that barrier so that it provides consistency for those employers who are up and down around that number 5, and also allows in those businesses that were previously not allowed in. So that's how we measure your number of employees. And then in terms of employee eligibility, as long as your employee is collecting a W-2 from you and is subject to unemployment insurance, if they're 18 years or older and have a social security number or an ITIN, they're eligible to participate in the program. So again, you know, all of your employees, whether they're part-time, full-time, you know, your seasonal staff, when they're on staff, will be included in your employee roster. We'll talk about that in just a minute, and should be given access, or at least the opportunity, to decide if they want to participate or not in the program. And you know, another thing that we always like to mention up front, you see at the bottom of the screen, is we don't see ourselves as intended to replace or compete with employer-sponsored plans. You know, the goal of this legislation, as I said, was to address this access gap that exists in the state. So if we see employers going out and finding, you know, starting their own 401ks or other retirement plan that qualifies, that's still a win for the legislation, because most importantly, it means more workers throughout the state are getting access to these tools that we know work to get them saving and on path towards retirement security. And I know Jan's going to talk about this in a little bit more detail at the end, but you know, if you're curious about what different plans an organization can use, you know, instead of CalSavers, we do have this list available on our website. It's at calsavers.com. If you go to the Help Center, it's the very first question under the Employer tab for the frequently asked questions. But any one of these plans would satisfy the requirement on employer organization.
So Jonathan, just real
yes,
quick.
ma'am.
So if you're a California nonprofit, but you also have employees outside California, can they enroll in the plan?
So that's a great question. So as long as the organization has 5 or more California employees, so they're collecting the California W-2 wages, then the organization is eligible to participate. And any of your employees that have California W-2 wages, you're required to include them on the roster of employees that you keep with us. Any employees that are out of state and receiving out of state wages would not be eligible for the automatic enrollment, so employers wouldn't include them on the roster. But we do have the program open for individual participation, so those out-of-state employees could sign up for CalSavers on their own, and then, you know, the organization could then facilitate their employees' payroll contributions if they wanted to help out with that.
Okay.
So there is a way to participate. It's just not quite as automatic as it is for the California employees.
Thank you.
Yeah, thank you for the question. That was a good one. So as any good state mandate it comes with some compliance deadlines, which are actually, we're 2/3 of the way through chronologically. So, we opened the program, fully back in July of 2019. And when we did that, it kicked off a 3-year phased rollout of compliance deadlines based on the size of the organization. So the first 2 deadlines, as I mentioned, already passed. Businesses with more than 100 employees, or I should say organizations with more than 100 employees, should have registered by September 30th of 2020. And organizations with more than 50 employees should have registered by June 30th of 2021. I did notice there were a few larger employers on the webinar today. So if any of you, are in this situation where you think you should be required to join the program and you haven't yet, please connect with us. We want to get you up and running. In addition to the compliance deadlines, there are some penalties for non-compliance. So we want to get you up and running before you start receiving those penalty notices from the FTB, from Franchise Tax Board. But the next deadline is actually coming up very quickly. We're just over 60 days away from this next deadline, and this is the big one. This is one for organizations with 5 or more employees. You'll have until June 30th of 2022. So again, just over 60 days. That's why it's really exciting to be in front of you guys today and letting you know about this requirement, because we are running out of time to get folks in compliance. But we'll talk a little bit more about some of the resources we have available to help you guys get up and running in just a minute. I mentioned this earlier, but since I have a note here on this slide anyway, I'll mention it again. For those organizations who are joining us, 21%, I think, had fewer than 5 employees. Remember, we are talking about the average number of employees that you had for the previous calendar year. But for those organizations that did have fewer than 5, you are not subject to the mandate at this time. And you're actually not allowed to sign up for CalSavers as an organization. But as I mentioned, the program is open for individual participation. So your employees are welcome to join the program. They can just go to calsavers.com and start their own account whenever they'd like. And then once they have accounts, even though you're not subject to the mandate, you can still help them with the payroll contribution if you want to play that role. But as Jan mentioned, stay tuned to the news on the Senate Bill 1126 that's going through the legislature this year. That might change. It would lower the threshold down to 1 or more employee. And those newly eligible businesses with between 1 and 4 employees would be given until December of 2025 to register for the program. That will be the compliance date set for those newly eligible businesses. Yes, Jan.
What if you're new? If you just started having employees in 2022, what's the rule on that?
That's a great question. So actually, in order for an employer organization to be eligible for the program, they have to have reported at least 4 quarters of DE9, quarterly wage reports, to EDD for the previous calendar year. So any business that is either brand new in 2022 or didn't report a full 4 quarters of wage reports to EDD in the previous calendar year would actually not be subject to the mandate yet. That organization probably wouldn't show up on our radar until the following calendar year, right? When we get fresh data from EDD. But the board did vote just a couple meetings ago to allow businesses or organizations to join early as long as they've had at least 5 employees in their most recent EDD wage report. So you would have to reach out to us and say, hey, we're a new organization, but we have 5 employees and we'd like to participate. And once we can verify through that wage report that you have 5 employees, we can let you in early.
Great, thank you.
Yeah, thank you for that question. So just by way of summing up the introduction before we get into what the requirements are for facilitating employers, I do just like to highlight what I think are the primary features of CalSavers. Number 1 is this employer requirement, right? Probably key takeaway for this: all California employers with 5 or more employees must register for CalSavers and facilitate your employees' access if the employer does not offer a qualified retirement plan. Primary feature number 2, it is designed as an automatic enrollment program for your employees. So we'll talk about that in more detail in just a minute. But, participation is completely voluntary for your employees, but they do get automatically enrolled if they don't opt out within the employee opt-out period. Again, we'll talk about that in a little bit more detail, but folks can opt out and opt back in at any time. The 3rd and 4th features I think are just kind of cool, and I like to share them with organizations. So number 3, we've designed the program as a public-private partnership. So we like to let folks know that the CalSavers program is professionally managed and advised by financial service companies with years of experience running retirement programs but they're running it with oversight from a transparent public board chaired by the state treasurer. So I think that's important because that means you get the expertise of these, professional financial firms running the program, but you also get that state oversight so that you know that the program is operating in the best interest of your employees, right, of the savers. And then fourth, the goal of this program was to create this program at zero cost to the state and the taxpayer and the employer. We're operating on a really small startup loan that we got from the state to get the program up and running, which we're required to pay back with interest once the program gets up and running. But once the program is up and running, it's going to be entirely self-sustaining based on the small fee that we charge our participants. So your employees, the savers, we'll talk about that in a little bit more detail in just a minute. But I think it's really exciting to be able to build a program with this large of an impact scale. Being able to help so many people secure their financial futures, being done at zero cost to the state and the taxpayer and the employer. I think it's pretty neat. All right, so that covers sort of the introduction with the background, the rules, how the mandate works, and what the compliance deadlines are. So the next thing I wanted to talk about was just a little bit about, what the requirements are for employers who sign up for CalSavers and facilitate access. But if there are any other questions that are in the queue right now that might pertain to what we've been talking about.
Yep. So just, fine tuning this question here. So if you didn't have 5 or more employees in 2021, but now you are over 5 employees, it sounds to me like you can't enroll in the program, but you could help individuals enroll. Is that correct?
So if you have 5 employees now, but you didn't, then you wouldn't be required to sign up as a business, right? Because you wouldn't be on our list yet. But once we can see that you've reported at least 1/4 of 5 or more employees to the EDD, we can let you in early. So you just have to reach out to us. We'll assign you an access code and get you guys up and running. But if either your organization isn't ready to sign up yet, or if you haven't reported those 5 or more employees yet, or at least we can't see it yet, then yeah, your employees would need to sign up individually, and then you could work with us to help them with the payroll contribution.
Great. And then what if an individual already has, has a retirement plan on their own, right? It's not part of the organizations. Can they still sign up for CalSavers and have like their own IRA and have a CalSavers account also?
Yeah, absolutely. So, a person can have as many IRAs as they can manage for themselves. The only thing that they'll need to keep in mind is that there are IRS contribution limits, which are combined between all of their IRAs. So if they have CalSavers and another IRA somewhere else, the maximum that they can contribute to both combined is $6,000. So they could, $3,000 in one, $3,000 in the other, or some other combination. Unless they're over 50, then they get an extra $1,000 in contributions that contribute $7,000 per year. So they can have them, they just need to be aware of the limits.
So if you already have a retirement plan, do you still have to register with CalSavers to say that you have one, or do you just kind of don't have to do that at all?
So we've done our best to try to scrub our list of any employers that we could find evidence that they have a retirement plan in place. So if you have a retirement plan in place and you're not receiving communications from CalSavers, then it most likely means that we've already crossed you off the list. If you have a plan in place and you're still getting the notifications from us, there's a really simple way to just register your exemption with us. Really quickly, you go online, you enter the access code that's on that thing and check a box that says that you have a plan in place, and that's it. And that way we'll get you off the list and we'll stop bugging you.
Great, thank you.
Yeah. All right, so let's talk about what facilitating CalSavers is all about for organizations that register and facilitate their employees' access. So, when the legislation passed back in 2016, one of the first things we did was get together a group of stakeholders, including CalNonprofits and other organizations that represented small business. But what we wanted to know from small business owners and small organizations in particular was, what is it about the programs on the existing market that make it difficult for employers to offer retirement savings options to their employees? And over again, we'd hear these same 3 hurdles. It's the administrative burden, it's the fees, and it's the fiduciary responsibility that an employer takes on for themselves when they offer an employer-sponsored retirement plan. So we tried to design CalSavers to address all 3 of those things. We've tried to make it as easy as possible for employers to facilitate. We're working with employers all the time to try to, identify the bumps in the road and try to smooth them out and make it easier. We're also working very closely with payroll companies, encouraging them to work with us on integrating their systems with ours, to, try to automate as many processes as possible. But even without the integration, the feedback from most employers is that it's much easier than they thought it was going to be, which is always great feedback. I mentioned before, there are no fees for employers to facilitate the program. Again, it's going to be entirely self-sustaining on the small fee that we charge the participants. So the only cost to the employer is going to be the little bit of time that it takes to bake the contribution process into your existing payroll process. And again, the feedback from the vast majority of employers is that the CalSavers process fits in really seamlessly with an employer's existing payroll process. And then, of course, because
Jonathan,
employers, yes, ma'am.
Before we get to that, so no fees for employers is really great. I mean, I know many times for people to set up a retirement plan, it's going to mean $3,000 to $10,000 from the employer right off the top of the bat to get it going. But I want to ask about employee fees. So I have a couple of questions here. So 3 questions about it. So one question is, how does it compare with other IRA programs? And the second one is, how can the employees tell how much is being charged to them? Because in some cases, those fees are wrapped into sort of these mutual fund accounts. And so can you address that sort of set of questions around employee fees?
Yeah, definitely. And I actually have a slide coming up in the Saver portion that actually shows the current fees for all of the investment products that we have. But, just briefly on both of those questions. So, we try to compare our fees a little bit more closely with, 401k fees because of the infrastructure that we built around the program. We see that as more like, they're more apples to apples than comparing ourselves with other IRAs. And when you look at 401ks, we're definitely on par. Our fees are less than 1%. Spoiler alert. And like I said, we'll go into more detail in just a minute. So for those of you who are familiar with IRAs, that's a little bit high for a mutual fund, but remember, we've had to build this administrative function around it to include, the record keeping and the payroll contribution process and all that stuff. So in terms of, comparing ourselves to 401ks, we're definitely very cheap compared to 401ks for small organizations. But again, the larger your organization is, the better deal you can get on 401k. So, but my advice, for employers would be, that's definitely one of the things to look at when they're trying to decide what the best path is for their organization. Look at fees, look at available investment options, and think about what's best for your business. And then the second question about how are employees able to see the fees. So just like the other, mutual funds or investment options that you mentioned, the fees for CalSavers are sort of rolled into the daily asset value for the investment. But we do, as a state organization, we always keep public all of our fees. So, you can go to calsavers.com at any time, and, there's a page dedicated to fees and other costs. And so we'll always have full disclosure on those. So while they might not be able to see them in their statements, it's always available online. So those are both great questions.
That's a good point. And like all things that, because they're government, there's recourse, ultimately accountable to the public. So I appreciate that point. Thanks.
All right. So let's see, we are on fiduciary. So, because the state is sponsoring the program and not the employer is not taking on the fiduciary responsibilities that they would with a traditional employer-sponsored plan. So, with a 401k or other employer-sponsored plan, you can often outsource some of the fiduciary responsibility. So other folks are monitoring the fees and the investments, but bottom line, if something goes wrong, the employers can be potentially liable. But with CalSavers, that fiduciary responsibility is taken on by the 9-member public board, chaired by the state treasurer that I work for, our small little staff at the state treasurer's office, and then our relevant contractors like the program administrator and the investment managers have all agreed to take on that fiduciary role. And again, make sure that the program is operating in the best interest of your employees, of the savers. So let's look a little bit more closely at what the actual responsibilities are for employers. The first 2 are relatively simple, one-time responsibilities for employers. So we mentioned those state required registration deadlines. Employers are required to register by that state required deadline. And then within 30 days of registering, they've got to take some time to set up their account. And again, this is just a really simple process of setting up the username and password online, telling us who, the responsible person that we'll be working with at your organization will be, and telling us a little bit about how you run your payroll so that we can help you get that part set up. Also, within those first 30 days after registration, employers need to submit a roster of all of their eligible employees. And remember, this is all of your W-2 employees who are 18 years or older and have a social security number or an ITIN. So all of your part-time, all of your full-time, anybody who's on your staff, even if they're seasonal or temporary, if they're collecting a W-2, should be on that roster. When you do that, that kicks off a 30-day employee decision period where, again, because the program's designed as automatic enrollment, we'll look at this in more detail in just a minute, but the employees will be able to decide if they want to participate or if they want to opt out. And then after that period is over, employers will submit contributions for those employees that did not opt out. So all of your participating employees, you'll take a deduction from their paycheck and send it to the program to be deposited into that employee's IRA account. And those last two are sort of the only,
And Jonathan, this will be facilitated through your payroll payroll provider, right? You don't have to do all this. You would say like, well, I use Paychecks or whatever, QuickBooks or something like that, and then that can get set up that way.
Exactly, yeah. So organizations will want to check with their payroll providers because we're seeing different levels of integration and different levels of support from each payroll provider. But I'd say at this point, with more than 40,000 employers registered so far, we've seen all types of payroll arrangements. And again, the CalSavers process builds itself in pretty seamlessly with an employer's existing process. So worst case scenario, if your payroll company isn't offering you any additional support, it's just a matter of having the payroll company add that line deduction that'll run every time you run the payroll, and then sending us a report of the employee contributions for each pay period. That's it.
Oh, we have a question.
And then
I thought that employees send their own money in and that it doesn't run through the employer, but it sounds like it does. It's from payroll deduction. Is that right?
That's right. That's right. It's a payroll deduction IRA. And the reason we've designed it that way is because, all of the research shows that that's the most effective way to get people participating and saving and on a path towards retirement security. I know even I've made that mistake where, when I wasn't automatically enrolled in a retirement plan, even though I knew it was important, even though I knew it was something I could do, I just didn't do it right away and missed out on the opportunity to be making contributions over a period of time before I did finally take that step to sign up.
That's the baby carrot story, Jonathan. That's the baby carrot
story.
Okay.
That's exactly the baby carrot story.
So a couple of more questions we have. So for the employee, is the contribution, their savings contribution to their CalSavers account, is that pre-tax or post-tax?
So the contribution that they make will always be post-tax because it's an IRA product. You put the money in after taxes, and we'll talk about this a little bit more detail in just a minute. But the default setting that we've chosen is a Roth IRA, so that'll stay pre-tax if they don't make any changes. But as we'll talk about in just a little bit, employees do have the option of converting that to a traditional IRA, which would make those contributions tax deductible. The good news for the employer is that for the employer, the contributions will always be post-tax. So you don't have to worry about, different tax calculations for different people. You don't even have to report it on people's W-2. We'll work with your employees if they do take that pre-tax option and help them take their deduction if they qualify.
Thank you.
Yeah. So let's see, those last two bullet points are really the only two ongoing responsibilities for the employer. So you'll continue to maintain that roster of eligible employees. So when you hire new employees, you'll add them to your list. And when employees leave your organization, hopefully they don't, but you can mark them as inactive and keep your list cleaned up. And then you'll continue to submit contributions for all of your participating employees with each pay period as part of your existing payroll process. Let's see quickly, a couple of things that employers will not see. I've talked about this stuff already, but it's always worth repeating. Employers will not incur any program fees. Employers don't have any fiduciary responsibility. And this is an important one because Jan mentioned it earlier in her introduction. Employers with CalSavers are actually not allowed to make an employer contribution. And that goes back to the IRA design. And in order to protect employers from liability, unfortunately, employer matches or other types of employer contributions are not allowed. So it'll only be the employees' payroll contributions or contributions that they make on their own that will be in their account.
So I want to just say something because I think this is important, so that even if you're not planning right now to be making employer contributions, if you think you will be doing that in the near future, you might want to choose something other than CalSavers. And well, you might be asking, well, this is ridiculous. Why aren't employers allowed to make contributions to match, for example, or just contribute part of the in addition to what employees want to save? And Jonathan can't say this, so I will, which is that, he's a government employee and he has to be official and fair. And that is when this bill was coming up, the creation of CalSavers was coming up, there was a lot of resistance from the for-profit business community because they were worried that it was kind of a slippery slope. And once employers had to offer retirement savings plans, that it would only be a matter of time before employers would be required to make contributions. And so kind of this was the compromise bill. It was worked out so that this would be created and mandatory to have a retirement savings plan. But to alleviate the fears about that slippery slope, CalSavers is not allowed to make employer contributions. So that's kind of the backstory on that, and just why you might want to just to be aware of that.
Thank you, Chan. Let's see. Couple of more things that I just like to mention that employers, sort of must not do, sort of the rules of the road also. So employers shouldn't be encouraging or discouraging participation in CalSavers. We see employer playing a really important role in letting their employees know that this is coming. We've got lots of resources available that employers can use if they want to help their employees know that this is coming. But we just ask employers to draw that line at encouraging or discouraging participation in the program. Employers shouldn't provide advice about investment options, taxes, or participation in the program. That's kind of table stakes, right? Most employers don't want to be in the position of offering financial advice to their employees. And then, of course, employers won't manage the investment options, process distributions, or manage any of the changes that employees have to make to sort of, maintain their relationship with the program. So, all of the changes that employees would need to make can be done directly with the program. So they're not knocking on your door asking you to change their contribution or update their address or anything like that, add a beneficiary. They can do all that with the program, and then we'll communicate any changes that would affect payroll to the employer before each pay period, so that you can make any changes that might need to be made. But this was done also on purpose to sort of alleviate some of that administrative responsibility that comes with some other retirement savings program. So again, we wanted to make it as easy as possible. And hopefully, looking at that, you see some of the evidence that we did put into it to try to make it as easy as possible for employers. So the next thing, I just sort of like to lay out those responsibilities on a timeline again, just so that folks get an understanding of what the timing is in this process. So I mentioned earlier, we've been reaching out to employers over the last few years, delivering invitations, which is a nice way of saying, hey, you're required to sign up for this, but it includes an access code. And with that access code in hand, you can register at any time, before your deadline. Again, registration is really easy. All you really need is your employer identification number and your CalSavers access code, which again is on your invitation to register. So again, once you register, and this is important, you have 30 days to get your account set up and upload your roster of employees. So, every once in a while we'll get an employer that thinks, oh, I'm going to register right now, and then I'll wait until I'm closer to my deadline to, upload my roster and start facilitating. Unfortunately, or fortunately, once you're in the program, once you register, you're sort of subject to the regulations, and the regulations again say 30 days to get your account set up and upload your roster. As I mentioned earlier, that action of uploading your employee information kicks off that 30-day employee decision period. We'll talk a little bit about what that means for employees in just a minute, but this is a good time for you as the employer to reach out to your payroll company and again, have them help you set up the deduction, see what other kind of support you might be able to get from them. Like I said, we've seen all different types of integration from different payroll services, and we're working on encouraging payroll companies to work even closer with us to establish full integration. But After the 30-day employee decision period is up, your employees will be enrolled in the program, and you as the employer can start initiating those payroll contributions, usually with the first or second payroll or pay period after that 30-day employee decision period.
So we have one person that's asked, Jonathan, that they didn't get an access code or a PIN, and they've been told, they tried to enroll in CalSavers, but they were told, what's your access code? And they said, we don't have one. What should they do?
There is an online process, or you can call the 800 number and try to get that access code. If you call the number and they're not able to give it to you, most likely that means that we weren't, either there is a mismatch in the information that was provided by EDD, or we don't show you as eligible yet, you know, either because your average was below 5 or something like that. But if you ask them to investigate, they'll actually refer your case to us here at the state treasurer's office, and we comb through that EDD data and try to figure out, you know, what it is that's preventing you from enrolling, and try to get you up and running if that's your goal.
Thank you. We just have still have people still concerned, like if you have a plan right now, like maybe it's a 401k or it's a 457 or it's a, you know, it's a simple IRA or something like that. Can you switch to CalSavers if you want to, or not?
Yeah, there's nothing that would prevent an employer from switching to CalSavers. You know, once you become familiar with you know, the different options that CalSavers has, you know, take a look and measure those options and compare it to what you've got and what you're offering your employees now. And again, you know, you'll be able to make that business decision about what's best for your organization and for your employees. But that actually covers the employer facilitation part. So, you know, the next section I want to talk a little bit about what the employees get, unless there's another question about the employer part that we want to cover before.
Well, we have, I don't know, 200 or 300 more questions, but let's go ahead and finish your presentation.
Sounds good. Sounds good. I'll try to get through this pretty quickly. I'm noticing that we're getting a little bit close to time here. So let's see. So how does this affect employees? Well, again, we'll talk about the features that, you know, the design features that we have here for the Savers. So again, we built the program around this automatic payroll deduction IRA, which means contributions are going to be deducted directly from your employees' paychecks. You'll do it as part of your payroll process. And those contributions will be deposited into the IRA account that's in your employee's name. They own it, they control it. It's theirs. It is completely voluntary for employees. I did mention that it's automatic enrollment. And again, we're going to talk a little bit more detail on that in just a second, but, you know, Savers can opt out or opt back in at any time. You know, they get to decide when they're ready to participate. We wanted the program to be as easy as possible for the employee, and that starts with the automatic enrollment at work. So, you know, the field of behavioral economics is remove all those barriers, get people started, get people on a path, and they tend to stick with it. That's sort of the idea behind the automatic enrollment. So they'll get automatically enrolled at the default settings, and they can either stick with that or customize their settings from our little menu of investment options that we've got. But we'll talk about customization in just a minute. CalSavers accounts are completely portable. So unlike an employer-sponsored plan that's usually tied to the employer, employees will get to keep their CalSavers account, you know, wherever they go in their future. Again, we hope that they don't leave your organization, but if for some reason they ever were to, they get to keep their account. If they end up at another CalSavers participating employer, their contributions from their new employer will go into their existing CalSavers account. And if they end up somewhere that doesn't have CalSavers, then they can keep their CalSavers account and let it grow on its own or continue to make contributions, or they can roll that money out into another qualified, you know, investment option. If employees are exploring that option, we always recommend check with a trusted financial advisor to make sure you're making the right decisions and the right moves there. But you know, bottom line, employees have complete control over their account if their employment relationship ever changes. And then, you know, we mentioned the program is, you know, self-sustaining based on the small fee that we charge the participants to cover the program administration costs. And I've got, again, that slide coming up with the fee details in just a minute. So the next thing I like to do is look at that timeline, but this time from the employee's perspective. And from the employee's perspective, again, it all starts out when you know, your organization uploads that roster of eligible employees into the CalSavers employer portal. And When that happens, we start sending all of the required communications. We have an employee information packet that we send out to folks. If you give us their email, that's how we'll deliver it to them. If you don't have their email, or if they prefer, U.S. mail, then you can give us a mailing address, and we'll send it to them by paper. But once you upload that roster, it kicks off that 30-day employee decision period. 30 days after being added to the roster, those employees are going to be enrolled in the program if they didn't opt out. And again, you as the employer will start doing the payroll contributions as part of your existing payroll process. But let's look a little bit deeper at the 30 days there. So during the employee decision period, your employees really have 3 options. Option number 1 is they do nothing, which means they get automatically enrolled at the default setting. Option number 2, and obviously this is what we encourage, right? All of our communications say, come to the website, give us a call, learn more about us, and we invite folks to customize their account, choose a rate that's good for them, choose their investments from our little menu of investment options, add a beneficiary, that kind of stuff. Option number 3 is they opt out. We even tried to make that part easy because, we're not trying to trick people into saving for retirement. We want people to make an informed decision. So, folks can opt out either by calling our 800 number, by clicking a few buttons on the website, or by filling out a form that we send with the employee information packet and mailing it back to us. So phone, internet, mail are the options for opting out. But let's take a closer look at the sort of standard features or the default settings and the different ways that folks can customize. So we mentioned already that we've chosen the Roth IRA as the default account type. So again, that's the post-tax option. So all the contributions, they've already paid taxes on the money. The benefit, in our opinion, for that is that, number 1, all of the interest that they earn over their career, once they reach retirement age, they get to withdraw their entire account balance over time without ever paying taxes on that money again, because they've already paid taxes on the way in. So tax-free growth, good thing. But the other good thing about it is that when you do post-tax contributions, employees have access to those contributions before they reach retirement age without paying taxes or penalties on it. So we thought that a lot of employees might like the idea of having some access to at least the contributions that they put in before they reach retirement age. That way, if they have an emergency, they can pull a little money out. Of course, if they withdraw interest is potentially taxed and subject to a penalty, but again, they'll always have access to their contributions in an emergency if they wanted to do that. For contribution rate, we're starting folks off at 5%, but as the default, but it does also feature automatic escalation. So that means we start them off at 5%, and then every year we're going to bump their percentage up 1% per year until it reaches 8%. So again, the idea is get them started, get them comfortable with the idea of saving, and then bump it up a little bit over time so that they can achieve, better savings over a period of time. And
Jonathan,
yes, ma'am.
We've had a couple people asking, but if an employee wants to save more than 8%, can they do that?
Absolutely. Absolutely.
Is there a cap?
So we'll talk about that in just a second.
Oh, okay, good. Go ahead.
Yeah. We'll talk about that in just a second. So, and then for the investment options, we wanted to make sure that even if people didn't engage with us and make an active choice, that they had an appropriate investment option based on their age and time to retirement. So we designed the program to sort of revolve around what's called a target retirement fund. Those are those mutual fund style options that, will automatically adjust as the saver gets older to become more conservative over time. So when they're young, it's going to be a little bit more weighted towards the stock. It's going to be a little bit more aggressive, but they have time to ride the market out. And then every 5 years, as they get closer to retirement age, it's going to become a little bit more conservative so that by the time they reach retirement age, they'll be taking less risk with their money. So again, if they don't make a decision on how they want to invest their money, we try to make sure that it's relatively appropriate mix based on their age and time to retirement. So for the first 30 days, we deposit their money into a money market fund so it's not exposed to the market. So folks that get automatically enrolled but didn't mean to can still access their money before it gets exposed to the market. But then after 30 days, we'll sweep all that money into the target retirement fund, and all of their subsequent contributions will go into the target retirement fund. All right, so customizations, we talked about this, so folks can recharacterize the traditional IRA. So if they want to take a tax deduction for the current year, they can do the pre-tax option with the traditional IRA. The other reason why this is important is because Roth IRAs do have income limits. So there are, if you have some high income earners at your organization, they might not qualify for a Roth IRA, but they can still recharacterize the traditional IRA, which does not have income limits, so they can still participate. contribution rate, employees, yeah.
What if a saver doesn't want to have their contribution escalated? Can they still keep it at 5%?
Yeah, absolutely, absolutely. So in terms of customization for the contribution rate, so savers can choose anything between 1% and 100% of their pay, as long as they stay below that IRS maximum of $6,000 per year, $7,000 if they're over 50. And then savers can, of course, turn on and off that automatic escalation feature. If they start at 5 and 5 feels good, we actually send a note that automatic escalation happens every January. And we send messages out to folks in December saying, hey, it's automatic escalation time. Let us know if you want us to stop it. And actually, well over 90% of our current participants are sticking with the default and accepting the automatic increase. So we're pretty excited about that.
Yep.
All right. And then, we wanted to make sure that people had options in terms of, how they invested their money, but we didn't want to overwhelm people with too many options. So we tried to keep a relatively small, tight menu that operates on the whole spectrum of, more conservative to more aggressive. So we've got the target retirement fund and the money market fund, which I mentioned earlier. We also have a core bond fund. So that one's a little bit more on the conservative side. We also have a global equity fund. So that's a mix of stocks from around the world. That one's a little bit more aggressive. And then we also have our sustainable balance fund, or ESG, which stands for environmental, social, and governance. So all of the underlying investments in that one are chosen based on, if they're environmentally friendly, if they're, if they have good social governance practices. So we thought it was important for folks to be able to invest that way if they wanted to also. So again, it's not so big that it'll overwhelm people, but it's a relatively good mix of investment options. And if as our savers mature, if we need to take on more options in the future, we can always do that too. But this is what we're launching with. So I promised this slide earlier. This is our investment option detail slide. I won't read the description. There's a lot of information on here, but there's 2 columns that I think are particularly important. The 2 columns on the right. So we mentioned the fees. Depending on the investment option that people choose, right now, our fee is between 0.83 and 0.95% per year. So what that means is 83 cents to 95 cents for every $100 they have in their account per year. And again, that is baked into the, to the pricing of the funds. But, we wanted, again, to be transparent about that. The other, good thing about the fees that we have in place is that built into the contract that we have with the program administrator, the portion of the fee that they get automatically goes down as the program grows. So, and our goal, obviously the board's goal is to make this as cheap as possible for the savers and to keep it that way. So, we'll always be laser focused on the fees and making sure that we're doing our best to make sure they go down.
So Jonathan, I guess.
But then the far right column.
So I have people say, are there going to be materials available and in what languages to help employees understand what their choices are and what they need to do?
Absolutely, absolutely. So our website right now is available in 10 languages. The top 10 languages spoken in California. We're looking to expand that, as soon as we can. And then all of our written materials are the same way. So 10 languages right now. We're also working very closely with stakeholders in other communities to try to work with folks who can help us spread the word about the program in language in a culturally competent way. So if you or your organization or your communities that you guys are working in have particular language needs and you want to work with us and with us getting the word out, we would love to do that. And we could use all the help we can get, to be honest.
Great. So I'm just conscious that we're already
Sure.
12:01. Do you have like 10 or 15 more
Oh my
slides,
goodness.
or how many more do you have?
I think we're about done. So
Okay.
the right-hand side is the investment manager. And then I wanted to share the resources that we have available, but we've talked about this already. The website is available, calsavers.com. We've got dedicated customer service lines for the employer and for the savers, for the employees, 8 a.m. to 8 p.m. Monday through Friday. And we've got a great field team available for one-on-one support, local support throughout the state. And all of these channels are multilingual. Even our field team can do presentations for employers or employees in English, Spanish, Cantonese, and Mandarin. And then our phone line, English and Spanish speakers available pretty much anytime, and then access to a language line too. So we're helping people in dozens of languages every day. And that's it.
Here's your
We made it to the end. I'm sorry for going over.
Not your fault at all. So I just want people to realize that Jonathan has put his email here. So, you know, if you want to email him and ask him like, where are the best carnitas tacos, you know, you could ask him that, or you could also say, you know, ask any of the questions that are in the Q&A box right now that we haven't had a chance to get to. And I want to apologize that, but it's great to see that we have so many people with so many interesting questions. I really love that. So thank you, Jonathan. We just have a couple more slides. I want to just run through like in 30 seconds. Just want to let people know that there are alternatives to CalSavers, and it is difficult to do a thorough investigation of all the different choices. There's a different slide than this I'm hoping would be up. But I think that I want to encourage people, especially, of course, if you're coming up against the mandated period when you have to have a retirement savings plan of some sort, that, you know, if you're feeling like it's just too much to look into all the different kinds of choices, it's a good idea to go ahead and enroll with your organization with CalSavers. Your employees don't have to participate if they don't want to, as a reminder. But also then it's easy for you to change in the future if you want to do so. So don't feel like making this decision locks you into CalSavers for a really long time. We also hear a lot of times the question about, like, you know, well, should I go to a bank or my savings, you know, our credit union, or should I go just open an account at Schwab or something like that? Thanks, this is the right slide. And I wanted to say it's kind of a mix and match. All right, so there's many different kinds of plans, as Jonathan mentioned earlier, and there are also many types of providers and brokers. So you can, if you have a trusted financial, like if you really love your bank or something like that, or your credit union, or then you can ask them to go out and look at all these different choices for you and help you understand what are the right choices and what's the right carrier. So for example, you may decide that a 401k is the right one, but then there's the question of which provider are you going to get that 401k through. So it is a little bit of this mix and match kind of situation. So you don't feel, so you realize that you have a lot more choices than you may feel like you have now. Just next slide. I just want to mention again, this is kind of a proverb that I really love that's especially applicable to this issue, and that's the African proverb that the best time to plant a tree is 20 years ago. And I think we'd all agree with that, right? Like, if only I'd started saving when I was 19 instead of now. The best time to plant a tree is 20 years ago, and the second best time is now. All right, so thank you, everybody. We have just one last slide that you can see, and Henry's going to close it out for us. Henry.
Thank you, Jan, and a big thank you to Jonathan for joining us today. I hope we all learned a lot about CalSavers, and just a reminder again that the enrollment deadline is June 30th. And here we go. So CalNonprofits is a membership organization. We hope that if you're not a member, you can you joined us. You can go on our website at calnonprofits.org to find out about all the different benefits that we have for our members. And if you sign up as a member within this week, you can use the code webinar22 and get 20% off of your first year of membership. Next slide. In addition to Jan and Jonathan, I want to thank our support team, Vanessa, and our captioner, Steve. And a reminder that the webinar and resources will be emailed to all registrants in a few days. All right, have a great lunch, everyone. Goodbye.